This is the FlipNerd.com Expert Real Estate Investing Show, the show for real estate investors, whether you're a veteran or brand new. I'm your host, Mike Hambright, and each week I bring you a new expert guest that will share their knowledge and lessons with you. If you're excited about real estate investing, believe in personal responsibility, and taking control of your life and financial destiny, you're in the right place. This is episode number 421, and my guest today is Scott Meyers. Scott's the nation's leading expert on investing in self-storage facilities. After a bad bout of dealing with tenants and toilets, Scott wanted an easier way to invest without many of the challenges that exist with single-family houses, and self-storage is where he landed. If you've ever wondered about investing in self-storage or are curious as to how it compares to other types of real estate investing, this is a must-listen episode. Scott doesn't hold back and shares the pros and cons of self-storage investing, as well as how to get started. Let's jump in. Please help me welcome Scott Meyers to the show. Hey, Scott, welcome to the show.
Hey, Mike. Thanks for having me. Good to see you again.
It's good to see you. I got to tell you, selfishly, I've been excited to have you on the show again. I don't have my notes in front of me. You were on here a long time ago. I think it's been at least a couple of years ago.
Yeah.
I know you've created some other content for us on Flip Nerd too about self-storage. But I got to tell you, I am at a point, I've been a single-family guy for 10 years, done really well. But I see self-storage units popping up, and I have some friends that are doing really well with multifamily. So some of the big boy investing has been exciting me lately. And I knew you were coming up. We had you booked here for, gosh, probably a month anyway. And I've been looking forward to this date because there's a lot of self-storage activity happening all around me. And I literally have some questions for you, not just for the show. Like I'm asking questions today that I want to know. So hopefully everybody gets some value out of that.
Perfect.
Yeah. Well, hey, Scott, before we kind of dive into it, why don't you, for those that haven't seen you on Flip Nerd before or not aware of you, haven't been to any of your events or anything, tell us a little bit about your background.
Sure. The 2-hour version or the
well, it's
the
about a 30-minute
version?
show, so yeah, if you talk as fast as you'd like.
I'll give you the podcast version. How's that?
Yeah.
So yeah, I started out investing in real estate. Had a job, Fortune 500 firm, and I just wanted to hedge for retirement. I didn't want to put all my eggs in one basket, meaning in Wall Street, even with a company match. And I read Rich Dad Poor Dad, and kind of saw the writing on the wall that wasn't a good idea. So I began buying single-family houses, and we were offering them up mostly following the Carlton Sheets method, which is buying, rehabbing, refinancing, pulling cash out, buying more, and just doubling down. And so we had a lot of rentals, but didn't have a whole lot of cash flow. And so I thought, all right, well, economies of scale will fix this. I'll just start buying apartments. And, I heard some guru somewhere talk about how great it is, and a property management company runs it, and they write the check, and all your problems go away for you. And, it's just much easier. Well, got into the apartment side, and that was just more tenants and toilets. And so we weren't selling anything off. I wasn't flipping anything out, which I should have to have some more cash flow. And then the recession hit in 99, the tech recession, which then, nobody had money. We had issues with people that were leaving. And then shortly after that, the Community Reinvestment Act was put in place where anybody that could fog a mirror could get a loan, which, as we all know, what has created, the Great Recession of 2008. Right. So all those years when that was in place, I was living the Big Short, except everybody was leaving my houses and apartments that we were renting to go buy houses.
You're
and
right,
so
right.
We took a nosedive, and then I realized that, hey, this is, I'm either going to stay in real estate and do something different, or I'm just going to get out altogether. And I didn't want to go back and work for anybody else. And so I said, well, I'll eliminate those problems of tenants and toilets and trash and being susceptible to this and get into self-storage. So I began looking into it, started buying self-storage facilities. And then for all the reasons I love self-storage today is the fact that there are no tenants, there's no toilets, there's no trash. There's people just storing their stuff. When the economy is good, people buy more stuff. When the economy is bad, people downsize. There's a demand for storage. And so we sold all our houses off and apartments and came out okay, not as well as I would have expected. But then since then, I've invested in other forms of commercial real estate, but just solely focused on self-storage right now. Just 100% more doubling and tripling down on self-storage.
Yeah, that's awesome. So maybe just take a minute to just say, I think most people know what self-storage is. They're driving, they see the little barn-like corrugated steel buildings that you could store your extra junk at. Sometimes you can keep a boat or an RV there.
Treasures.
Just kind of explain
treasures, Mike.
What's
you
that?
Don't store your junk there. They store their treasures there.
Treasures,
yeah.
yes. So explain to me, the listeners here, maybe to extrapolate on that a little bit, like a little bit more about what self-storage is, because I know it comes in lots of different flavors, right?
Yeah, it does. So I think most people's exposure to it is on the shows, Auction Hunters and Storage Wars, where people bidding on the units. Well, I'm on the other side. I own the facilities, and so the business model is pretty simple. They move their stuff in, they rent it. It's a month-to-month rental, which means I can I can raise rent anytime I want. They store their items in there, and they all assume that it's only going to be there for a month or two. But at the end of the day, these folks stay for year after year after year, and we increase their rates. If they don't pay, then we are protected by the lien laws that we have in self-storage, not eviction laws, because we all know in habitational real estate, eviction laws protect the tenant. Whereas with self-storage, it falls under the lien laws and warehousing, where we are protected. So if they don't pay, we put a lock on their unit, and they can't get in until they pay us 100% their back rent and late fees. And then if they don't pay, then that's exactly what you see on TV, which is storage, where we auction their stuff off to recoup our back rent and late fees. And so,
you hope there really is some treasure in there, then, right?
We do. I mean, the more the better, because then it drives prices up, and we get closer to, or sometimes even more than the amount that they owed us in back rent and late fees. Now we don't keep any extra. We can't, but gosh, if we recouped 100% and we send the check off to the last known name and address of the person that was there, that sure beats where I was with the tenants and toilet business, whereas I'd walk out of court with a little piece of paper, yellow, pink piece of paper, and zero ability to be able to collect any rent on that almost. And then they would trash the house on the way out because I was evicting them, and they were mad at me because they didn't pay. Where in storage, if we auction it off, no tenant, it's not a tenant, client can come back and do anything. Or if they leave on their own, all we're left with is a steel box and a concrete slab. So we blow it off, take a blower, blow it out, move to the next person waiting in line, and that's it. We don't have carpet and paint and drywall and
holes in walls, and somebody left 4 dogs there and stuff like that, right?
Yeah. That's it. So, after looking at the business model and then being in that business model, it was really easy to step away from everything else and haven't looked back. This is all we do now.
Yeah. So, Scott, we talk a lot about single family on this show. And, of course, we love all real estate investing. But talk a little bit about how this market has impacted self-storage. Like a lot of people in single family, they feel, from an investing standpoint, like they feel like, hey, it's more competitive than in a long time, hard to find deals. But when we get them, we tend to be more profitable than usual. So kind of talk about, just tell us for folks that are single family investors here, like how that feels to a self-storage investor right now.
Yeah, sure. So we, again, the economic cycles are a little different on our end because there's a run up in demand for storage during a recession. So when people are downsizing and businesses are downsizing, when they're moving back home, moving in with somebody else, or they're subleasing their office and they still put all their equipment and inventory somewhere else, it goes to storage because it's least expensive per square foot. So we have this run up in demand during a recession, and at the same time during a recession, the banks, they are turning off the faucet on their development funding, their speculative funding, when they're in the midst of it, because they want to look at historical cash flows. So perfect storm for the investors that are already in self-storage. They can fill up their units, and then if they have access to either capital from their own bank or private equity, then they can expand their facilities or develop. But we're left with this place where those that have facilities are in really good shape, and those have cash or access to private equity. So when times are good, same thing. People are buying more stuff and they need more stuff, and then that's when we have the development end. So we come out of really 2012 is when we begin to come back out of that recession. What we saw is a lot pent-up demand. There was somewhere in the neighborhood of $25 to $30 billion in development that was needed to keep up with the demand for storage, and so. We started seeing the banks loosen their purse strings. They could see, what was going on in the marketplace, and they started lending again. And so we saw a lot of development. And some of your folks, if they've paid attention, they'll see a lot of self-storage facilities being built. And we're still trying to keep up with demand. I think to the layperson, many, I don't know how many people say, well, man, market must be saturated. I see them all over the place. No, we're way behind. We're still trying to catch up. So from our standpoint, the way we approached it, buying existing facilities, and then we were coming back out, then everybody, knows the business model works extremely well. So had a lot of people coming into self-storage, which was driving prices up for the sellers. Sellers are getting top dollar, but in many cases they didn't want to sell because then they have to do a 1031 exchange if they don't want to pay taxes, and then they get a fine. another investment on the back end
Exactly.
that was as good as the last one, and then they were paying top dollar on the back end. So some were holding on. So then we saw the shift in development, even from some folks entering the marketplace that were a little less advanced, and started developing buildings, converting anything from grocery stores to industrial buildings, warehouses, skating rinks. I mean, you name it, industrial buildings that have zoning or close to it being converted, and then either running them themselves or getting them ready to convert or partially developed and then selling them off to the big guys who were trying to keep up with their investors and selling them shovel-ready deals.
Okay. If you're an active real estate investor already doing deals and looking to double or triple your business, you should consider joining the Investor Fuel Real Estate Investor Mastermind. We're a small group of investors that share our best practices, tips, and tricks with one another in an effort to all win. We limit our membership to only 1 to 2 members per market, so everyone shares their knowledge, tips, and tricks openly and honestly. Our members include some buying 1 to 2 houses a month, up to some of the most respected investors and leaders in the real estate investing industry, some of which have personally done over 1,000 deals. If you'd like to be considered for our invitation-only world-class mastermind, please visit investorfuel.com to request your personal invitation. Our next meeting is coming up quickly. Go to investorfuel.com now to learn more.
Entering the marketplace that were a little less advanced, and started developing buildings, converting anything from grocery stores to industrial buildings, warehouses, skating rinks. I mean, you name it, industrial buildings that have zoning or close to it being converted, and then either running them themselves or getting them ready to convert or partially developed and then selling them off to the big guys who were trying to keep up with their investors and selling them shovel-ready deals.
Okay.
So I think I'm going into the long version of this, but
no, it's interesting that you said turning. Literally, there is. I drive past it every day when I take my son to school. There is an old Kroger grocery store in Texas that has been converted to self-storage, and and then literally a mile or two from there, there's an entirely new development that's been opened for. In fact, within there, as I think about it, within a couple miles, there's a couple different ones that have popped up over the past year, 18 months, let's say. So, but the other ones were kind of built from the ground up on land, and then this other one is a little more probably heavily populated right there, and they just popped it right in an old Kroger grocery store that had just been sitting there empty for probably like 5 years or more.
That's our favorite. If we can find some of those buildings to repurpose because they're already in an urban location, and it's an infill location where it's a lot tougher to get zoning to build a self-storage facility because it doesn't generate a lot of tax revenue. I mean, the cost to build it is inexpensive, and the revenue it generates is not very high on a comparatively to other asset classes like retail or multifamily or office. Okay. So the assessments are lower, which means that the city isn't apt to approve those as readily as some others. But that's why we love to be able to find the older buildings that are in those infill locations that already have zoning in place. It's quicker to market because you don't have to build as much. It's quicker to get zoning and entitlement and everything else. And so that's it. If we can get those locations, it's much easier and a shorter path to profitability than it is a ground-up development.
Yeah, it's kind of interesting to think about. Honestly, across America right now, retail has been hammered, right? Like a lot of the big stores, malls are not doing so well. Not that you'd want to build one of these in a mall necessarily, but I think probably every town across the country right now has big old grocery stores, or it used to be a Montgomery Ward's or whatever it's been. That retail company is gone, and I guess that opens up a lot of opportunities for self-storage.
It does. Yeah, it really does. I mean, the lion's share of the conversions, and I don't want to say the lion's share of all deals or units coming online are conversions, but boy, there's a lot of them just because of all those reasons. And we can buy the buildings on the cheap, less than it would cost to build those again. Yeah. And then when we go inside and we're just putting up walls and doors, it ends up being, we can end up with a Class A temperature-controlled self-storage facility in a perfect location, retail location with high traffic counts, in some cases for less than the cost of going out on the outskirts of town, buying some land and developing a single-story facility that's a Class B that is not temperature controlled. So that's the attractive business model right now.
Yeah. So you said something a minute ago. I want to clarify that I heard this. Yeah, it's the economy's hot right now in pretty much everything. You guys are in a development cycle, but when the market turns down, your self-storage investments will actually perform better. Did I hear that right?
Yeah, I mean it's we've been through I've been through three recessions now. The first one I didn't even know what was going on. The second one we ended up about breaking even. The last one we came out all right, and now we're poised for the next one, and we're going to be big players in the next one.
Yeah.
And so yeah, for the reasons I mentioned, we demand goes up in self-storage. I saw one stat, and I don't know if this is true or not, although they were stats that said that self-storage is second only to one other sector of our economy in terms of growth and profitability during a recession. Can you guess what the other one is, or what the top one is?
Across all industries?
Yeah.
Say alcohol?
Yep. You got it. Liquor.
Yeah.
So number one, people can't afford to go on vacation. They'll go on a vacation at home, right?
Vacation in their mind.
Second is, what's that?
A vacation in their mind.
Exactly. So the second is self-storage, because there are so many people downsizing and businesses downsizing. And again, the development funding drops off. Yep. The banks stop all that speculative funding of everything. They go back, if they're going to lend on anything, it's existing, and they can look back on trailing, history. Because during a recession, nobody knows what's going to happen, and the banks, financial models are all thrown by the wayside. So yeah, storage continues to go up and to the right during a good time, boom times, but then actually during a recession, it skyrockets.
Wow, that's
in both valuation and occupancy. And so, it's called the inflation-proof and recession-proof business sector, and that's one of the things that attracted me to it. And now that I've lived it, and I've been through an economic cycle and a half in self-storage, I've experienced it, and yeah, so now our business model right now is get real good at what we're doing at the moment, which is developing, converting, and buying existing. But we're really behind the scenes. We're building up a war chest of cash, and we have private equity investors, and we're going out. I spend a lot of my time doing that, just introducing self-storage and the business model, in a more elaborate fashion than what I just mentioned as to why they should be investing in it, especially as we head into, the next recession, whenever that is.
Right.
So we're building up a war chest so that when the banks shut things off, and the people that shouldn't have had loans, or when they comes time to refinance and they didn't have good terms on their existing facilities, then we're going to step in and buy those. Developments, awesome. If we can do some developments, I mean, that's equity intensive. If we can, again, get some of that lending, even 50% LTVs from the Small Business Administration and others, and marry that up with the private equity piece, then, I won't say that we won't skip a beat, because we do use lenders and we layer our equity on top of that, but we're going to continue to move on where, most of the other folks, especially the novices and the rookies, when they're out of cash, they're out of business. And we're going to be major participants in the next recession, and we're going to clean house.
So for folks that that might be interested in investing in self-storage, would you say, that haven't in the past, would you say, is it too late? Like, did they miss the boat? Are we at the peak of investing activity there? Or
yeah, I'm getting a lot of those questions, as you can imagine. Just leading into, I guess, everybody in real estate is right now wondering, what's the case. And so yeah, we have a lot of folks that come to our events and just talk to me about that, because once again, an unfair assumption that, or unfounded assumption that they see these things being built all over the place. Oh, I missed the boat, and everything's at the top of the market right now. How can I, possibly get in? Well, it's not the case. We're still way behind. Development's a little tougher to get into from the get-go if you don't have a vast amount of experience. The banks, they want to know that you have experience in either real estate development or self-storage experience, and then obviously self-storage development experience is, a key to that. But it doesn't mean that you've missed the boat. Buying existing facilities and going out and doing the exact same things that that I did when I was buying single-family houses to either rent or eventually flip. We're talking about mom and pop owners, in many instances, the same types of people. So just going out and searching for those existing facilities and talking to those folks about them. Yep. And, it's the value in commercial real estate. I don't know how many commercial folks you've had on here, Mike, but, the value in commercial real estate is based upon the net operating income. It's not based upon comps. You pretty up a self-storage facility, and then you compare it to the other one. It has nothing to do with that. That's one factor, a small factor. It's how much income is it generating, and what are the expenses? What's my net? And then, applying a market capitalization rate to it. So there's opportunities to be found on existing facilities right now, and then certainly on development and conversions. And the business model is to keep it for yourself during the recession, but also because these regional players and national players in the self-storage business, their job is not to go out and find those development opportunities or to find the Krogers. They're waiting for the brokerage community, commercial brokers, to bring those deals to them.
Okay.
Well, commercial brokers aren't doing the things that we as single-family investors were doing, which is sending out yellow letters and postcards and mailing and talking to those folks. So finding those deals and then either getting them under contract, carrying them through on our own, or presenting a shovel-ready deal to the national players, the regional players, and making money in that sense as well. So commercial wholesaling, commercial flipping, doing a little bit of work, if you will, is a fantastic way to make money in this business. So
wow,
I'm not sure
incredible.
if I answered your question or what the original question was.
Yeah. I mean, it's interesting because there's obviously, you just explained a lot of ways you could effectively, just like single family, find deals and wholesale them on to other people that appreciate that they didn't have to do that work, right? But that's fantastic. And I guess another way to invest is just to be the money, right? You could just be an investor. So talk about that a little bit. Talk about kind of being the private money behind these deals and not having to do any of the stuff that you've talked about so far.
That's what we learned through the Great Recession is that the lending was and all sorts was just really limited, and the regulators were coming down, the FDIC was coming down, all these banks were making these loans,
right?
And so when we looked at the amount of loans that we could have picked up at that time, your growth is usually limited by the amount of cash that you have in almost all instances. And there's also some deals that were so bad because the valuation, as I just mentioned, on commercial real estate is based upon the NOI. In some cases, the price would be here, but the net operating income was down here, but it was only 10% occupied or 20% occupied. So just a small amount of income, and the price was up here. Well, when it was full, the value was up here, but the value is down here now because it wasn't generating a lot of income. But even if you were to get a loan to buy it here, this amount of income doesn't cover the debt service coverage ratio. It doesn't cover. Yeah. So the banks just said no anyways. So those deals for us just fell off the desk and went by the wayside. And then I realized we had a number of those fall off because we saw that, it's here right now if we buy it, but holy mackerel, here is what the value would be when it's 85% occupied. And I just wanted to curl up in a corner and vomit. And I said, okay, well, let's not do that. Let's just go find private equity. Yep. And we show them that if we can take it from here to here and then we split it, whatever that split is, that gives them, I had to learn about that world, their internal rate of return, what is average, what are they looking for, how long do they want to be in, 3 years, 5 years, what's the risk, all that. I got really, really good at raising private equity. And I had no problem. I knew what I was looking for, but I also wanted to see what the market was looking for. So we got really good at that, and then we started raising private equity, and then very quickly went back through the trash can and dug out all those deals and all the others that came upon our desk, and the deals that were going back to the bank, the development deals, the conversion deals that the banks weren't funding, we were funding with the private equity investors. And then when funding came back, as we were out of this recession, then we were layering that private equity on top of loans, which means that we could grow that much faster because we only had to create this much of a gap or bridge this much of a gap with the private equity instead of raise it all. So
because
right now,
your investors were willing to take equity instead of necessarily debt or interest, is that right?
Yeah, nobody was a debt partner. Everybody was an equity partner, so they all took ownership in the deals. And so I took ownership and I invested in those deals as well. So I had skin in the game in all of those in addition to that. And you kind of have to if you're going to ask other people for money. They want to know that you're doing the exact same thing.
Right.
So we began doing that and growing that way. And now we're building a war chest, again, to take advantage of what's going to happen in the future. And we're ready and poised. And right now, I'd say 95% of the deals that we're doing are all have some form of private equity involved in them and no cash to very little cash of my own.
Yeah, that's awesome. That's awesome. So Scott, where are we? Are we in a bubble? I mean, are we in a bubble here? Where are we at in the cycle? I know that it's funny. We talked a little bit beforehand, and things that I thought might happen 2 or 3 years ago, like they still haven't happened, and I just kind of gave up on guessing. But if you had to guess, where are we in the cycle?
Let me see here. It's not there. I was looking for my crystal ball.
You can't find it. Huh?
Yeah, 2 years ago I said 12 to 18 months. A year and a half ago I said 12 to 18 months. A year ago I said 12 to 18 months. And it's not just me. I mean, I'm
the same way. Yeah.
listening to anybody, and I'm not listening to everybody, but there's a handful of places that I think these people have their fingers on the pulse of what's going to happen, not only in the economy, but then also how that affects real estate and what people are doing. And we have these conversations in the groups of investors that I get together with all the time, and we continue to keep skipping over where we feel the time in which, we should be there. You look at all economic indicators, it's funny, Mike, yesterday I gave, my kids are homeschooled. They go to school a couple days a week, and I went to present an economics class about what starts a recession, and then all about the Great Recession, and talking about the Big Short and everything else. And the indicators, here are the indicators, and that is, consumer confidence, high unemployment, high debt as a country and as individuals. And so, these are, and then 2 quarters of economic downturn, then we're in a recession. Well, we haven't had 2 quarters in which, the factors that we measure our economy by have fallen yet. But we are seeing a rise in credit card debt and default up to 8% now. No matter how I'm not going to get political here, but the last administration doubled the debt in this country. It went from 10 trillion to 20 trillion. This country's in debt, and the value of this country and its debt isn't worth as much anymore. So that alone, tensions in the Middle East, high oil prices, which we're seeing right now, and then and overall consumer confidence, so and business bankruptcies being up. So all of those are happening, but just to a small degree, with the exception of 2 consecutive quarters of the other ways that we, determine whether our, real GDP is down. So there's a lesson in economics for all of y'all out there in 30 seconds. So until we get to that place where we have 2 consecutive quarters where, some very drastic things happen, which causes the consumer confidence to erode, we don't know. There could be, this tariff war that, not this tariff war. It could be a tariff war that Mr. Trump is teetering on by some of the tariffs that he's putting in place. A trade war caused by some of that. I mean, we're one little issue away from kind of tipping us over the edge right now. And if nothing happens, the economy's chugging along, modest interest rates. Things are moving ahead right now. So I don't know. If I had to guess, I'm still going to say 2 years out because
I know.
History repeats itself every 7 to 10 years, like clockwork, since the beginning of time, since we began tracking financial models. And an economy, whether it's ours or the world economy, goes into a correction or a recession. And so we're just flat out due. And again, you go all the way back. We're 10 years out. The last one was 2008 is when it began. 10 years
into a 7 or 8 year cycle, right?
Yeah. And we're there. So there you go. There's my long-winded.
No, that's awesome. And I guess the great thing about your model is that nobody wishes the economy would have a downturn. But if it does, your business with your existing units, you pull back on development, but the existing units will do probably better than they do now even.
I was scared to death. And when we went through it with the houses and the apartments, because the values of those plummeted. And, if you're left without a model where you're selling and flipping, I mean, folks don't hold on to a lot when you start seeing it coming. Keep that cash in play and be liquid and be able to get in and out. We didn't. We had 80 houses and 400 apartments, and we were stuck. And that was a scary place to be. But right now, I don't have any of that, and the asset class that I'm in goes up in value, and we've got a whole bunch of cash, and so we're really kind of, you're right. We don't want to see the economy go down. That's bad.
Right.
But for us right now, that's going to be our Super Bowl, or those, the 3 to 4 years that we're in the bottom of it until we start coming back out. That's when we're going to clean house.
Yeah. And I say the same thing on single family. We're preparing right now for the storm because I've lived through that before. Last time I did well, but I didn't really know, like I didn't plan for it. It just kind of happened. This time I'm planning for it. When there's a downturn, I'm ready to go to town.
Oh my gosh. Yep, those that have cash and are liquid and fluid and can get in and out and not holding a lot are going to be in really good shape. So I think that's the best advice that I have.
So Scott, for folks that are listening to this, I know you share a lot of information. I know you have events, you have all sorts of stuff. I know you have a lot of great information on your website. If folks wanted to learn more, maybe kind of talk a little bit about getting started, and then maybe tell us where they might be able to go on your website to learn more. But first, just start off by telling us if folks are like, hey, let's just presume they've been interested in single family, because we have a lot of those folks that are listening to our show, and they hear this and they're like, oh, I can supplement it, or I can move in that direction, or I can just skip over single family if I haven't started yet, whatever it might be. Maybe talk about how to kind of get started, I guess.
Sure. So we have we kind of have 2 camps over here, and where we spend our time. So I spend a lot of time working with folks at a higher level, both on an education and also partnering with them as well. But what feeds that is, we have educational events and all types of tools and resources to get people involved in it. So yeah, you can buy self-storage facilities for less than the cost of a single-family house in most markets, and add it as another tool to your tool belt, another strategy to put in your investor portfolio. And so selfstorageinvesting.com is where that all starts, and we've got courses there for free to kind of dip your toe in the water to see if that is of interest. And we have home study courses, we have software to evaluate facilities. And then our 3-day live events, which is a kind of 3-day immersion workshop where we touch on all the aspects of finding, evaluating, purchasing, and managing self-storage facilities. It's very intensive. It's not all encompassing. And then we do have some mentoring programs for folks that want to do it a little bit faster or want to go further, or they're going to make a change and be all in. And then we do with an aspect of that is also partnering. We partner with our folks where they go out and we teach them what it looks like to, anybody can get a lead on a self-storage facility, but there's a difference between that and a deal. So we show them how to determine whether it's a deal. And then once we determine if it's a deal, what's it going to take to get it across the finish line? And if that includes some of our resources, some of our private equity partners, our lending relationships, my signing on, being part of the LLC, and then assisting in the management with our management companies afterwards, just 100 ways from Sunday to get a deal done. What kind of resources does that person need from us to get it to the finish line, and then we determine if it makes sense for us to partner on it. So that's probably the long-winded version.
That's great. We'll add links for your site down below here.
Anything from beginner to intermediate to advanced, we have something in which we can work with folks on the education and the partnering side.
Okay, we'll add some links down below for that for folks that want to learn more. I know you got a lot of great information on your site. Maybe tell us at a real high level, if folks are like in there's kind of two camps in single family. It's either build your list of people that want to buy, especially if you're going to wholesale, and then go find the deals to kind of fill those orders, if you will. I'm in the other camp where I'm like, hey, if you find a deal, it's no problem finding somebody to sell it to in this market. What comes first in self-storage, the chicken or the egg? Like, is it about finding the deals first, or is it about raising money first?
No, it really is. It's about, the folks that work with us, at least they know they have access to equity, or we have access to equity. Yeah. And so, I think not everybody, many people think that they have to, do all those things first. You first of all, you can't go to a bank and get pre-approved because they'll say, what am I pre-approving you for? Because it's based upon the value of the deal, right? What does the deal present? They're not as concerned with you as they are with the deal. So raising some private equity helps, but if you're not actively putting deals in front of folks, again, that's just conversation. That's just an elevator talk without much behind it. So everybody wants to do those things, and they want to have their LLC and logos and everything set up. None of that matters until you go out and start finding opportunities, leads that actually turn into deals. So it begins with the knowledge of knowing the difference, what's a lead and what's a deal, and how to make it a deal, and then knowing what to do with it after that, given the resources that individual has. I got a real estate experience, I've got some cash, I've got decent credit, so I'm going to take this to my lenders once I have what I think is a deal to a lender, and then some private equity investors, and have that conversation with them. Awesome. If it's too big, if it's too far away, if it's something that I don't have the capital, I don't have the experience, then they're going to reach out to somebody like our organization or some other folks in a local market that are players, and either have them assist in partnering if they bring anything else to the table. But in many cases, if they're broke and they don't have good credit, doesn't mean they can't do the business. It just means that they're probably not going to be a part of that deal going forward. They are a bird dog. They will be assigning those and getting referral fees. But the good news is, for the wholesalers out there that are listening right now, you may be getting $5,000, $35,000 on a wholesale deal. We're talking about self-storage opportunities, whether they're conversions or existing facilities or development opportunities. Add some commas and zeros to that, and we start a minimum of $10,000, and that's a minimum. But most of our referral fees or assignment fees are in the $50,000 to $75,000 range. And one right now is going to close for one of our students is going to make $227,000 fee for that. So
for finding the deal, wow, that's great.
It is. So that's it. It's learning that side of the business, and the knowledge of understanding, hey, truly, what is a deal that I can present to the self-storage investor marketplace to either partner with, or until I get to the place where I'm an investor, let's generate some of these referral fees so I know what I'm looking at first. Yeah.
Wow. Awesome. So, well, guys, we're going to add down below in the notes here how to learn more from Scott's website. I'll put a link down below. I know you got a lot of great information out there. Scott, thanks for spending time with us today.
Hey, my pleasure, Mike. Thanks. It's good to get in touch again.
Yeah, I think it's important to continue to educate yourself in this space, and I told
always.
Scott before we started here, I'm hoping to come to one of his upcoming events because I'm fascinated by this investing opportunity, and I finally have got to a point where in my life where I have time to go learn more. Right, I've had my head down for so long, and we've done well with that. But there's so many opportunities out there to make money. So maybe listeners here, maybe I'll see you at an upcoming event. But we'll add a link down below. Scott, thanks again for spending some time sharing your information with us.
Hey, my
everybody,
pleasure,
hey,
Mike.
this
We'll
is
save a
episode.
seat for you.
Go ahead, Scott. Say that one more time.
I said we'll save a seat for you, and love to have you here. So thanks for having me. It's good to spend more time with you.
Absolutely. Hey, everybody, this is episode number 421 with Scott Meyers. Very interesting information here. Hopefully you got a lot out of it. If you haven't yet, if you love this show or you love listening to our show and you haven't yet, please go ahead and subscribe to us on iTunes, Stitcher Radio. Leave us a positive review if you would, or anywhere else where you might listen to our podcast. You can also subscribe on YouTube and watch our shows out there. Of course, you can watch and listen to over 1,500 podcasts that we've created on flipnerd.com. Appreciate you guys. We'll see you on the next show. If you're an active real estate investor already doing deals and looking to double or triple your business, you should consider joining the Investor Fuel Real Estate Investor Mastermind. We're a small group of investors that share our best practices, tips, and tricks with one another in an effort to all win. Real estate investing can be a lonely business for successful real estate investors, but it doesn't have to be. Investor Fuel members meet 4 times a year, but we talk to each other 365 days a year, and we focus on improving the profitability of our businesses, improving the quality of our lives. That's why we do this, right? And making an impact on those around us so we can truly leave a legacy. We limit our membership to only 1 to 2 members per market, so everyone shares their knowledge, tips, and tricks openly and honestly. Our members include some buying 1 to 2 houses a month, up to some of the most respected investors and leaders in the real estate investing industry, some of which have personally done over 1,000 deals. If you'd like to be considered for our invitation-only world-class mastermind, please visit investorfuel.com to request your personal invitation. Our next meeting is coming up quickly. Go to investorfuel.com now to learn more. Thanks for joining us for this episode of the flipnerd.com Investing Show. If you're not yet an elite member of Flipnerd, you're missing out. We have tons of great training, including a new detailed master class published each month and live training webinars with experts twice a month. Plus, you'll get access to all of our archives, where we already have a growing library of master classes and other training videos. Elite members also get membership in our incredible online mastermind group, where many of the top real estate investors from across the country, including many of the hundreds of guests I've had on the show in the past, are already members. Whether you're brand new, looking to get started, or a veteran, you simply must join today. I promise you won't be disappointed. To learn more or join today, please visit flipnerd.com/lab. That's flipnerd.com/lab. See you on the next show.